Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Got a pretty good episode here to talk to you about today. A lot of interesting things going on in the mortgage world. And of course, we're thankful that the hurricane in Florida has passed and didn't turn out to be quite as devastating as hoped. We, of course, still wish all the best to those who have been affected. What I want to get into today is a couple of things. First of all, as you know, we like to get right into the mortgage and bond market. The first thing we like to do is bring you our rate grid. You probably heard the news. Mortgage rates have actually been up lately, contrary to expectation. But when you look at our rate grid, all is not lost. Mortgage rates are still pretty darn good compared to where they were just a month or two ago. You can see we're still we're no longer in the fives on conforming 30-year fixed, unfortunately, but very low sixes, 6.125. FHA VA still in the mid fives. Unfortunately, we were low fives not long ago. Jumbos are still hanging in there at 6.25, 15-year at 5.5. And look at those buy downs. You can still get a first-year rate 3.125 on a 3-2-1 buy down, 4.125 on a 2-1 buy down. Those are very good tools to use if you're going to get in the purchase market and try to negotiate an offer. I would suggest that you consider that as part of your strategy. Ask for a seller credit to get those funds to use to buy down your rate to those levels. I think it'll make quite a difference for you. And again, don't forget our tab at the bottom about mortgage rates. Be sure to take a look at that. That used to be a big long article. We've converted it to a video where I go into much detail about how mortgage rates are determined. So for those of you new to our website and to our rate grid, take a look at that because I think it'll shed some light on how the heck these numbers even come up. So with that, let's talk about the bond market. It's been a really interesting few days, and that, frankly, a couple of weeks in terms of how the bond market has reacted after the Fed announcement from mid-September, when they announced a 0.5% reduction in the Fed funds rate. There you can see the chart right now. It's not the kind of trend we like to see. If you go back and look at last Friday, when we were down in the 3.85 range, now it's all the way up to 4.6, almost 4.7. But that's actually off the highs. Earlier this morning, we were up to 4.11. And when you do the math, then you realize that that's why mortgage rates have gone up so much. In fact, back on around September 17, the 10-year bond yield was actually at about 3.6. So you're talking about a 0.5% in yield since the Fed announcement. I mean, go figure. They lower the Fed funds rate 0.5%, and the bond yields and mortgage rates are up 0.5%. Well, let's talk a little bit about that, at least as it relates to what happened this week in the financial markets. And there's a few things to note. First thing is, in terms of the financial markets and economic calendar, very light. Pretty much no significant economic data points released the first 3 days of the week. And instead, Monday, Tuesday, Wednesday, as I put on there, and I'm not sure my grammar is all that good, Fed minutes on Prez and governors speak. What that means is Monday, Tuesday, Wednesday, various Federal Reserve presidents, Federal Reserve governors were giving speeches about their thoughts on where we're at on the economy, on mortgage rates, the labor market, et cetera. Also, what happened this week is the Fed did release their minutes from their last Fed meeting, the meeting from mid-September when they lowered the Fed funds rate by 0.5%. What those minutes showed is that a substantial majority of the Fed officials at that meeting did support the 0.5% cut in September. So that's why it happened. Their belief was that would help strengthen the economy and the job market while it would bring down inflation. And then, of course, the other thing that happened this week is there was a bond auction. Last week's episode, we talked about what other factors can affect the bond yields and therefore mortgage rates beyond just economic data points. And one of the things I pointed out was flow of funds. A bad day in the stock market can sometimes help the bond market and help push that 10-year yield down. But the other thing that can affect the bond yields is new bond auctions. And this week we had a couple of them, a 10-year and 30-year bond auction. And midweek, yesterday in particular, the bond auction for the 10-year was okay, but wasn't a resounding success. And that did require the bond yields to move up a little bit to get those bonds sold. So that's an example where it's not a data point per se. It's just new supply of bonds hitting the market that investors are going to buy. And sometimes I've got to tweak those yields upwards to get the investor motivated to buy them. So that's part of what's happened this week in terms of elevating our bond yields. The major economic data points this week are today and tomorrow, the inflation numbers. And today was interesting. Today, the CPI, the Consumer Price Index, that's inflation at a retail level, it was forecast to be 2.3% year over year. Now, keep this in mind. Last month, August, or the last month released, August, was 2.5%. So the forecast was for the CPI year over year to drop 2.5 to 2.3. Well, the announcement this morning, 2.4. So what's interesting about that is it came out one tick, we call it, 0.1 higher than forecast, and yet still lower than the month before. So you consider that good news, right? Well, not exactly. The initial reaction of the bond market was, this is bad news. Inflation is, and I hate the term anymore, hot. That the number was hotter than normal. That's what the media's favorite term is when the forecast is a miss and the number comes out higher than expected. They call it hot. Well, I don't know if it's hot. Maybe it got a little lukewarm, but 0.1 over forecast and yet lower than the month before. Well, they took the glasses half empty approach and said, wait a minute, it came in higher than expected. That may temper or cause the Fed to slow down on lowering the Fed funds rate. So that was the initial reaction. And so mid-morning this morning, the 10-year bond yield got up as high as 4.11%. But as you saw on the previous slide, it's already come back down to about 4.06. Core CPI was the same thing, forecast at 3.2. It did come out at 3.3 year over year. So one tick higher than expected. And so that part is part of the reason the 10-year bond yield, at least initially, was elevated upwards. It's actually right now, slightly below what it was yesterday. So it's good news that, the reaction occurred, but it's settled down and it's come back to slightly better than yesterday. So the next market move, if any, will be tomorrow. That's the producer price index at the wholesale level. That's inflation at the wholesale level. The forecast is 1.8. Year over year is 1.7 in August. So we'll see how that comes out. If it's 1.8 or lower, that'll be good. And you should see some improvement in bond yields and therefore mortgage rates. So for those of you who are starting to get, to be more nerdy about looking at the stuff like I am, first thing in the morning, fire up your computer, Google the 10-year bond yield, take a look at where it's at, look for the headline about the PPI, and that'll give you an idea where mortgage rates are headed. So with that, we're going to go ahead and bring Jeff in because we're going to talk a little bit more about these issues in terms of what the heck has happened in the bond and mortgage market over the last couple of weeks since the Fed announcement.
Hey, Art. That's so true. Some of the things you're talking about here, it's crazy that we get good news, but it's bad news. And we get bad news, but it's good news. So, one of the big things is I thought, hey, can we talk about some of the stuff like what's happening with rates? The biggest thing, and I know it was like there was this media selling us this bill of goods now because of the Fed interest rates. They kind of made the general public believe that, hey, when those rates get cut, it's going to help everything, including housing. But I think Jerome Powell was very clear when he talked about it. No, it doesn't work that way. Can you tell us why the rates have actually gone up instead of gone down? Now, I see on your report where the good news is if you have a home equity loan, man, those have really dropped quite a bit since the first of the year.
Right.
But everything else, not so much. So can you help us with that?
Yeah, a couple things. First of all, on the home equity loans, or in particular the HELOCs, the home equity lines of credit, yeah, those have been helped. Of course, the media doesn't quite make that clear or make that distinction. HELOC is a second mortgage. It's a home equity line of credit. I call it a credit card secured by your house because it behaves in a similar fashion. And the interest rates for those are determined entirely differently than a long-term 30-year fixed rate mortgage. They're generally tied to the prime rate. The prime rate is directly correlated to the Fed funds rate. So when the Fed lowered Fed funds 0.5% mid-September, HELOC programs, existing loans out there, did or should have experienced a reduction in their rate because of that action by the Fed. So a HELOC loan, yes, there's a direct correlation. Now, when it comes to a long-term fixed rate mortgage, there's no direct correlation at all, as we've talked about before. And so that's why I always urge people as we approach the next Fed meeting, which, by the way, everyone, The next one's in November, the day after the election. There is talk still that they are going to lower the Fed funds rate again. What's happened with what's occurred since mid-September is the market has sort of recalibrated their forecast for that reduction. There was a point right after the Fed meeting in September that the markets were so enthusiastic that the expectation was that they're going to go another 0.5% lower in November. That's off the table. At best, the expectation is maybe another 0.25% and 0.25% in December. So I think that's still on the table. But what's happening here is this last 2 to 3 weeks has been a great case study for everyone to understand why the Fed should not be the focus when you're looking at mortgage rates and where they're going or where you want to predict they're going. Mortgage rates are all about the bond market, as I've said time and time again. It's all about data points related to the economy and the things that the bond market focus on. And by the way, that the Fed focuses on are really two things primarily: inflation and the labor market. And so the reason why, even though we had that 0.5% reduction in the Fed funds rate in September, mid-September, the reason we didn't see mortgage rates fall is because soon after that, we had a labor market data point released, the jobs market. This is as of tomorrow, it'll be 2 weeks ago. And it came in substantially higher than forecast. It was supposed to be 150,000 new jobs. It was 250,000 new jobs. That was a big, what the heck is going on moment, because that was way beyond what was forecast. And the markets, particularly the bond market, reacted accordingly. And why would the bond market care? Well, the idea is if you have that many new jobs added to the economy, that's probably going to mean that there's going to be more dollars out there to spend, and more dollars being spent on products and services can generally mean they're going to drive up the prices. And so that was considered a signal that maybe we're not through with fighting inflation. And in fact, inflation could reverse course and creep back up when you have that many new jobs created, putting that many more spending dollars into the economy. So that's really a simplified version of how the market reacted and why mortgage rates, well, actually starting with bond yields, and therefore mortgage rates went up after the announcement, not after. And again, I've said on this program to everyone before, the reason there's such a correlation with the bond market and mortgages is most mortgages made in the U.S. are collateral for bonds. They're called mortgage-backed securities, or Ginnie Mae, Government National Mortgage Association securities. And so because mortgages are the collateral for bonds, that's why there's such a correlation between the bond market and the mortgage market, and therefore mortgage rates. And then compound the jobs report from 2 weeks ago tomorrow with this week's inflation number, at least today's inflation number. That's another focus on, wait a minute, maybe the inflation fight is not quite over. Maybe it's ticking back up, and that may give the Fed pause from being too aggressive on lowering the Fed funds rate further. Now, I think after that initial reaction this morning, it's calmed down a little bit. I think the 1/4 point in November, 1/4 point in December is still on the table. But that's barring any other economic data points between now and that first week in November that might again underscore that maybe the labor market is not only solid but strengthening. And if we have any more inflation numbers that tick upwards even more, then that's to watch out for.
Well, let's talk about that just for a second. Okay, you've given us an idea of why we're here, where we're at, but what about moving forward? What's your? Let's put your cap on, look in your crystal ball, and give us an idea of what does the next 90 days look like, or at least let's say to the first of the year, 90 days.
Well, again, like I just said, I think the expectation with the Fed, at least, and again, not a direct correlation, is a 1/4% reduction in November, 1/4% in December. And when you looked at some of the presentations and the speeches given by the Fed officials this week, because there was a lot of them. There was literally over Monday, Tuesday, Wednesday, there must have been a dozen different presidents and governors of the Fed giving speeches. Many of them still talked in terms of that more rates are going to be needed to kind of keep things in balance. So I don't think the Fed has backed away entirely from the belief that there's more to come in terms of rate reductions in the Fed funds rate. But at the same time, they're trying to essentially uh, kind of get everybody's expectations managed to realize, look, we're not going to just cut, and have rates drop a point or 2% in a very short period of time. They're going to take a very gradual approach. And the part of the reason for that is they're going to keep the eye on the other major item they're always looking at, the labor market. So as long as the labor market numbers don't get any stronger, then I think we're going to see a gradual reduction in the Fed funds rate. And again, barring any release of new, stronger labor market numbers, that should allow the bond yields to start settling down gradually, and therefore mortgage rates. But there's upside risk there. You got to realize that can change on a dime, like this last couple of weeks has shown. I mean, that jobs report 2 weeks ago was a shocker, a big shocker. Now today, not so much. I mean, it was a better number than August, but slightly worse than was forecast. In my mind, I think ultimately by the end of the day, this afternoon, the market is like, wait a minute, this isn't entirely bad news. It's slightly better. Mm-hmm. So I think that's really the focus is going forward. We've got to pay close attention to the inflation numbers that come out, the labor market numbers that come out. If there's no more shockers, we should be okay. I think we'll see some gradual reduction, but then understand there's an upside risk. If one of those numbers come out way out of whack, beyond forecast, that's where it's going to be another one of these, well, this is a family show, I'm going to say, WTF moments where they go, wait a minute, what happened here? We thought we were on the right track of, continual and frequent rate reductions. Even that notion that did come out mid-September, that's calmed way down. It's like, okay, we get it now. Let's not get ahead of our skis, as they say, and realize this is going to be a gradual and longer process than expected. Than first.
I'm sorry.
Than first expected.
Yeah.
When the first announcement came out.
Now, you mentioned something as one of those indicators to keep an eye on was inflation. Let's talk about that. What about the inflation? You said it's slowing in September, but what about going forward? Do you see that, the signs are lining up, those other economic indicators are lining up to say, hey, you know what, if that's a driving force, is inflation in check and going in the right direction to encourage Fed and, quite frankly, the bond market to say, hey, it's time to lower some more rates?
Well, yeah, I think so. I mean, again, the key thing I think will be the next, jobs numbers report, because I think the September jobs number report was a little bit sort of on the fringe in a sense that it was a much bigger number than expected, and so assuming that when the next release comes, if it's more subdued, I think that's going to help things. Remember that the Fed's inflation target is 2%. Well, if the CPI year over year currently is at 2.4, well, gee whiz, we're not that far off from their target, right? Again, it was a year and a half ago, it got up to 9%. So the Fed, to give them some credit, has done very well in getting us back to the target goal of 2%. But, getting that last 0.4, 0.3 out of the number, so we're back to 2%. It's going to be important that the labor numbers get more subdued, and I think they are. In fact, there's some observers, Wells Fargo Bank, for example. I read an article. They were bullish about today's number. They were expecting it to come in as forecast at 2.3. They were off slightly, but they are of the belief that there's going to be future job numbers in the rest of this year that are going to show some more softening. And I think if that proves to be true, then we're going to see the inflation numbers also keep going in the same direction. But this is going to be a very gradual thing. I think to get to 2%, we may end up looking at maybe not getting there by the end of the year, but maybe first quarter of 2025, or even beyond that a little bit. So I think it's going to be a case of chipping away at a very slow pace. But as long as that pace is in the right direction, I think we're going to eventually get there.
Well, you mentioned about the employment numbers, and I was watching something today where they think that the unemployment numbers and the claims will be a little higher, but they said they've already baked this in because it's really weather related, because we're talking about those states were hit by Hurricane Helene last week, and now Florida, and there's going to be some bump in those claims, and so they've kind of already baked those in. They're really good about that, about baking them in, but sometimes a little bit, not quite Betty Crocker wise, but they sometimes overdo it, don't they?
Well, they do. That is a term that's used in the financial markets about considering sort of seasonal changes or unusual changes due to something like a weather related event that has a temporary shock on the numbers. And so I think on the labor market side, you're right. If we see some increase in initial jobless claims, which we probably will, you got to take into account when those are occurring as it relates to other events going on overall, like a weather related event like a couple of major hurricanes. The baking in term is interesting because as I was trying to urge people early September, late August, early September, approaching the Fed meeting, I kept saying it. All the people I'm interacting with, prospective borrowers, home buyers, homeowners looking to refi, is, hey, look, the improvement that we're expecting on September 17th or 18th is already baked in. Take advantage of it now. If it turns out we're wrong and things improve after that, you've already locked your rate, and then we can do a renegotiation of your rate, but at least you protect the upside. Unfortunately, I had a few folks who just, like nodded their head, duly noted, and decided, no, I think the Fed is who I want to wait for because I think that's going to help. Well, of course, we now know it didn't, and we now know the reason why is because the Fed doesn't directly control your mortgage rate. It's going to be the labor market. It's going to be the inflation numbers. So I think this has been a kind of a painful but learning lesson for prospective borrowers, both on the purchase side and the refinance side, that you've got to look at other factors. And if you do that, I think you're going to be better equipped to deal with this and not put yourself, frankly, in an emotional roller coaster that can occur when you are in a transaction, for example, and you decide to float because you're waiting for the Fed, and then things go exactly the opposite of what you expected. That can be very, very stressful. And that's another reason why locking in a rate sooner than later, I think, is always, always, always the best recommendation.
Well, our next guest, if you will, he actually has this whole major strategy on how to handle this interest rate stuff. And I want to bring this in. It's a major mortgage and interest rate strategy announced by our friend, Dave Ramsey. Talk us through this, because you know what? I feel like, wait a second. Has Dave been listening to your show and just took notes and said, hey, I'm going to announce this a major strategy, when quite frankly, Art has already done this many times? But please take us through this major announcement.
Yeah, I'd like to take credit for it, actually, and maybe I should reach out to him and say, hey, can I get half that check you're getting for making these announcements? But I don't have quite the notoriety that Dave Ramsey does. But yeah, Jeff, you're right. I mean, I took a look at that article when that was brought to our attention, and I had to chuckle a little bit. And again, this is another example of how I think the media and their use of adjectives, I'll say, can really be overdone at times, because you're right. The headline basically was, Dave Ramsey makes this major announcement about mortgage and interest rate strategies. And I just thought there's got to be something more to this. So I read the article, and it was, again, it gave me a pause. It kind of just made me chuckle. Why? Well, he actually had 6 points, total of 6 points of this strategy. Well, guess what the first one was? It was, look at and what was interesting about the article is it started off talking about the purchase market, but it very quickly switched to just talking about refinancing. And it was actually the refinancing transaction where he had these 6 major points that he wanted the readers to know about. Well, guess what the first one was? Review the numbers. Make sure that the refinance transaction that you have available to you makes sense in terms of what kind of rate you're going to get, what kind of monthly savings you're going to get, and what it's going to cost you to get that refinance. So review the numbers. That was his first major step or of his strategy. And then the second step, as part of this major strategy, was shop around. Well, that's kind of a duh moment, right? Of course, you should shop around. You should talk to more than one lender. And when you do, a couple things about that. Number one, when you do, and you're going to compare quotes, get a quote, get a specific quote, and get it in writing. And if you're going to get multiple quotes from lenders, get them all on the same day. That's very, very important. I can't stress that enough. Why? Because when you want to compare quotes, they all have to be based on the same market conditions. So if you get a quote today and you're comparing it to a quote from 2 weeks ago, you can't do that. That's not a valid comparison because it doesn't. Each quote reflects different conditions on that day. So you always want to shop around, of course. And if you're going to get quotes, get them in writing, get them in detail. You can get a worksheet, not a loan estimate, because that's an official document. You can get a worksheet, get it in writing, get it in detail, and make sure that when you get multiple worksheets, it's all within the same day. The third thing he said was when you're going to make the decision to compare the rates, the rate offered, and the closing costs. Well, again, another duh moment. Of course, you're going to do that. If you're going to shop around and you're going to get quotes and you're going to get them in writing, then you're going to choose a lender based on who's going to give you the best option in terms of the rate and the closing costs. And once you compare all of them based on the same day, then you can make your decision. So that's just kind of obvious common sense, right? So I don't know why that's a major strategy, or at least a major strategy to announce. That's already a given in this business and has been, frankly, for years, if not decades. The fourth thing he said, and I will support him on this, once you've made your decision and chosen a lender, lock your rate immediately. Don't float it. Don't get caught up in thinking the Fed's coming up with the next meeting and that's going to help the rate improve and therefore you're going to wait. We've just all learned that in this last couple of weeks. Don't hold off on your rate lock. Just lock it. Get it in place. Set your mind at ease. You know what your worst case is. I can't tell you how important that is just emotionally to eliminate anxiety and stress. So if you start a refinance transaction in particular, not to mention a purchase because you got a limited amount of time to close, lock the rate. Don't mess around on that. If you turn out to be quote unquote wrong, thinking that a week or two after you start your transaction, the mortgage market has improved, rates are better, all is not lost. With almost any lender, we can renegotiate the rate lock. We can make a request to renegotiate the rate lock if things improve. But if you lock immediately, you're protecting your upside. And I can't stress how important that is. So with that fourth, major point in Dave's strategy, I will support that 100%. He is right. Now, the fifth one is, of course, you got to go through the underwriting process. Again, that's obvious, common sense, nothing new. Our job in particular as a mortgage broker, our job is to help you navigate through the underwriting process and get you through that process as quickly and as efficiently and with the least amount of stress as possible. And one thing I'll tell you about the underwriting process, the best thing to do when you're confronted with a list of conditions or items that the lender wants or their underwriter wants, don't dispute it. Don't resist it. Just give them what they want. That's the best thing to do. I always tell people that, look, some of this stuff doesn't make sense. Some of it seems illogical. Some of it seems like a pain in the rear. But don't get bogged down complaining about that. The best thing you can do when you're going through the mortgage process, and in particular the underwriting process, when they ask you for a piece of paper, you can grouse about that and complain about it. I'm happy to complain to me about it. I'm a good listener. I'm going to help you understand why they're asking that for that. And let's just get it to them as quickly as possible. I can't stress that enough. It will make the process much more anxiety-free and less stressful, and get you closed quicker than otherwise would happen if you get bogged down in resisting what they're asking for. So just cooperate. You can provide your commentary, but just give them what they want. Take the path of least resistance. You'll be happier in the long run, and you'll get your deal closed sooner. And then, of course, the last major point of his strategy was close the loan. Well, obviously, you're applied for the loan. You want to close the loan. So after you get through the underwriting process, you're going to get your file to something called clear to close. We call it CTC. So once you get to CTC, then you're pretty much home free. It's just a function of going through the closing process. First, there's going to be a document called a CD, or closing disclosure, that'll be issued to you. You've got to sign that. Then you have to wait 3 days before the next step, which is the actual closing documents that have to be signed. And that's what has to be signed for the loan to actually fund. If it's a refinance transaction, you have to wait 3 more days after that for a right of rescission period. If it's a purchase transaction, it can close literally or fund literally within a day or two after you sign your closing documents. So Dave's major mortgage and interest rate strategy in reality is just common sense steps you should always take. And frankly, most borrowers have always taken, but it's a good reminder of the steps to go through. And in particular, like I said, always lock in your rate right away. Always get your quotes in writing. And when it comes to underwriting, just give them what they want. Don't resist. The sooner you do that, the sooner you're going to get to that happy stage of closing your loan. So that's my comments about Dave Ramsey. Like I said, I wish I was getting the kind of checks he's getting for that kind of advice.
Well, I looked at your major points, and I'll be darned, they were exactly the same. I was going to add to it, but I'm like, these are exactly the same. The only thing that I wanted to ask you about was when you talked about shopping around, and I flashed it on the screen there just for a second. And I think it's important to note, when you're out there shopping around, your rate is going to be determined by what the broker is being paid on their lender fee. Yes or no?
Yes, in fact, yeah. Thanks for bringing that up, because I failed to mention that. When someone is shopping around, whether it's a purchase mortgage or a refinance, and in particular a refinance, when you shop around, understand that when it comes to the mortgage originator you're dealing with, in particular if it's a loan broker, the rate you're going to get is going to be affected by or influenced by how much that broker is going to be paid by the lender. All of us brokers, when we sign up with lenders to deliver loans to them, we have to basically sign a document that declares what we want that lender to pay us when we deliver a loan to them. And that document has a range of what they call lender paid comp, running from 1% up to 2.5% of the loan amount. Well, common sense tells you, when you're comparing a originator to originator, and if one originator only wants a 1% from the lender for the loan, and another originator wants 2% from that lender for the same loan, well, you're going to get a higher rate with that lender or that originator who's asking for 2%, because it's not free. I mean, the lender is going to pay that 2% to that particular originator, but it's going to be reflected in your rate. And if they've got to pay 2% instead of our 1%, you're going to face a higher rate than if you get a quote from us. And that kind of spread, 1% versus 2%, that can be easily a quarter or 3/8 of a percent in rate. So yes, all the viewers should know, when it comes to the loans we originate, in particular refis, we will originate that loan at a 1% lender paid comp. So if you're going to shop around, as you should, be sure to check with us too. We will give you a written detailed worksheet right away, no delay. I've heard borrowers say, "Oh, I'm still waiting a day or 2 or 3 days later." It shouldn't take that long. You call me, I can have it to you in an hour or two. Get that. Understand that what we're going to quote you is based on us only getting 1% from the lender, and that's going to mean a better rate for you.
Art, thank you very much. I was going to ask one more question, but that would only be rubbing salt in the wounds of those people who didn't lock in their rate when you suggested. With that, Art, I'm going to turn it back over to you. Great. Thanks for answering so many good questions. And remember, Art with Mortgage Works is the home of 1% broker lender fee. So as it says, hint, extremely low saves you money. So if you're paying more, you're paying more. Thanks, Art.
All right. Thanks, Jeff. Okay, as you know, we'll now go to our closing question from last week. Here it is again. It's about trigger leads. When we applied for a purchase mortgage last year, we were bombarded with phone calls and text messages from lenders. Why did this happen, and how can it be prevented? We've covered this issue, actually it's been a few months ago, and I wanted to bring it up again because it's kind of back in the news. First of all, as to the trigger lead phenomenon, I'll tell you, most importantly, it's abusive, it's predatory. It can be a real bother and a hassle to borrowers who have submitted an application for a mortgage, whether it's a purchase or a refi. So what exactly does it entail? Well, what happens is it's a lead generation and a sale of customer data by major bureaus to lenders. And it's done without your direct consent, if you can believe that. In this day and age of having to provide consent for just about anything, it's remarkable that this practice, which is abusive and predatory, is even still allowed. And believe it or not, this practice was actually the trigger lead phenomenon was actually the way was paved by the Fair Credit Reporting Act all the way back in the 70s. I won't get into the detail and the technical part of why that is, but just understand that going back to legislation from literally 50 years ago is what's paved the way for trigger leads to even be allowed. And of course, when this happens, we as the originator often get blamed for this trigger lead phenomenon. And we have nothing to do with that. In fact, what's happening is after we originate a loan and we pull the credit report on the borrower, and specifically a hard pull credit report, your data is being sold to other mortgage originators by the three bureaus, TransUnion, Equifax, Experian. And those are the folks who now call you. They text you day and night, and they try to create doubt, and they provide you all kinds of claims that they got a better deal and you need to switch your application to them, and so forth and so on. I've had customers tell me they literally get 100 calls in a day or two, or text messages, or both, because of this. What I want you to know is there is an amendment to the National Defense Authorization Act that will prohibit this practice. What's important about this is, unlike previous attempts to legislate a solution and a prohibition of this practice, is that it was done through other separate bills before Congress. In this case, it's an amendment to the National Defense Authorization Act. Well, that's something that gets passed every year. And so in that respect, having this attached to that legislation is good, because it gives us a much better chance that it may actually get passed. And if it does, it's going to prohibit this practice. And you, being as a mortgage borrower, again, whether you're submitting a purchase application or a refinance application, will no longer be harassed with these kind of calls. So in the meantime, how do you opt out? Well, as I put at the bottom of this slide, you can sign up for opt-out pre-screen. It's the official consumer credit reporting industry website. You can opt out online, by phone, or mail. You can call 1-888-5-OPT-OUT. Again, 1-888-5-OPT-OUT, or as you see, 1-888-567-8688. You can choose to opt out for 5 years or permanently. So for all of you who want to avoid this, if you're looking at getting a mortgage in the near future, I would recommend taking the opt-out step now, while we wait for this legislation to get passed and get the prohibition in place. It'll save you a lot of headache in the future if you are going to be applying for a mortgage in the not too distant future. So I thought it was a good topic to bring up. I hope that you see that as helpful information. And with that, we're going to go ahead and go to our closing question for next week. And this is actually something that I had somebody kind of complaining about here with one of our own customers. This was somebody who had told us that when they last got their mortgage, last time they got a mortgage, they said that they provided their tax returns. But they said there was a bit of a delay at closing because the lender asked them to get a 4506 tax transcript from IRS. But they're asking, since we already provided our tax returns, why did we have to do this? So I'll give you an answer to that very good question next week, on next week's edition of the Mortgage Minute. And I'll have the answer, and it'll be on the house. So I want to thank you all for watching and listening to the Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. We'll see you next week. So long. Take care.